Hello everyone. Today I want to talk about capital gains and what changes have been made in the new 2024 federal tax budget and how this relates to you and potentially your property. So first of all, we want to talk about what are capital gains. Capital gains are basically any profit that's made off the acquisition of an asset. An asset can be a stock, it can be a bond, it can be electronically traded funds, it can be a secondary property, or it can be a business asset. So in the instance of property, it can be a rental property, a vacation home, anything that is not your primary residence. And in order to calculate your capital gains, you're going to take what you've made on the disposition of that asset. So when you sell your asset, how much money did you get for it? You subtract what you paid for that asset back on day one, and you can also subtract any expenses associated with the disposition of the asset. So if you have to pay any commissions, if you have to pay any legal fees, if you paid any renovation costs, fixing up, say, a rental property before you sell it, those can all be taken off of the profit. And if it's a loss, then it's a loss and you don't pay any. Shouldn't you get taxes back if you make a loss? Never works that way, does it? So once you've figured out what your capital gain is, if it is a gain, then you have to determine how much is it going to be taxed. So let's use an example of a rental property. Say you purchase a rental property for $500,000 and it's going to cost you $100,000 in legal fees, commissions, and renovation costs to sell this property. And then you sell the property for $750,000. So now you've realized you've got $150,000 left in profit. Now, if you are not a corporation, you're just an individual person, you will only be taxed 50% of that $150,000. So that's going to be $75,000 will be taxed. What's going to happen is that's going to show up on your taxes as income realized, and it will be taxed at your marginal tax rate. So depending on what tax bracket you're in will determine what level that $75,000 or what rate that $75,000 is taxed at. So what about this 66%? What are we talking about? So that happens if you realize more than $250,000 in your profit, then instead of 50% of that being taxed, it's going to be 67%. Now, how does that work? Basically, let's use that same example we had before with the rental property. You put your rental property on the market, and this time you sell it for $1 million instead of $750,000. So original purchase is $500,000. We spend $100,000 to sell the asset. We sell it for $1 million, and now we've realized a $350,000 profit. Now, because that is over $250,000, 67% of that is going to be taxed as your income at your marginal tax rate. So ultimately, $231,000 is now up for grabs for taxable income. Now, this can be, everybody's got different situations and everybody's got different planning that they need to do. If you've got questions about your secondary property or your primary property for that matter, and how this relates to you, I would be more than happy to sit down and discuss your options. Again, I am a real estate agent. I am not a tax accountant, and there are great people out there to help you with your tax prepping. I've got great people that I work with if you need a referral. And I hope you're all having a great day. Thanks for watching. Leslie McDonnell here with RE/MAX Select Properties.